You spend weeks fine-tuning your strategy, waiting for the perfect conditions. Then, the perfect setup materializes at 3 in the morning while you're sound asleep. Or maybe you are awake, but the pressure gets to you. A sudden gut feeling or spike of frustration pushes you into a revenge trade, wiping out weeks of disciplined, profitable execution in a matter of minutes. Many retail traders think they only have 2 options to solve this: either chain themselves to their charts 24 hours a day, or build a complex, flawless algorithm that prints money while they ignore the markets completely. There is a practical middle ground. It's called the Quant-Lite Framework. It allows you to remove the human error of manual execution while still utilizing your high-level insight to guide the strategy. The first step in this framework is changing how you think about market data. As a human, you might look at a chart and say the trend looks strong. A computer cannot process strong. It needs binary, true or false conditions. We translate intuition into objective parameters. Instead of a vague feeling, define strong mathematically. Price above the 200-period moving average and ADX above 25. Decisions follow an if-then-else architecture. If conditions are met, open an order. Else, do nothing. By forcing your trading rules into this strict mathematical structure, a setup is either valid or it isn't. While the urge to meddle might remain, you've now established an objective line in the sand that makes it much harder to justify emotional trading mistakes. Once your logic is clearly defined, you need a software environment to express it in code. For retail traders, this usually comes down to choosing between accessible, all-in-one platforms and advanced programming languages. MetaTrader's native languages, MQL4 and MQL5, offer the path of least resistance. They handle the basic plumbing automatically, connecting to your broker and managing order tickets natively, making rapid deployment very straightforward. But if your strategy requires complex data analysis, you will likely outgrow MetaTrader. By using APIs to connect Python directly to a broker, data scientists can integrate machine learning models or run sentiment analysis on social media feeds to trigger trades. The goal is not to declare one programming language superior to the other. It is about assessing the complexity of your specific strategy and selecting the tool that executes your rules with the least amount of friction. This graph shows a trap. You see a smooth upward equity curve with a 90% win rate in backtesting, but in the live market, it crashes. This is curve fitting, over-optimizing parameters to perfectly map historical noise, instead of finding a genuine predictive signal. To prevent this, you apply the 70-30 rule. You segment your historical data, using 70% strictly for developing and optimizing your strategy. The remaining 30% is quarantined. You only test the finished algorithm on that out-of-sample data once. You can push this further with walk-forward analysis. This method tests the algorithm on a small slice of data, moves the testing window forward slightly, and tests again. This mimics the reality of live trading by forcing the bot to constantly adapt to shifting market cycles. A high historical win rate tells you very little. An algorithm proves its worth by surviving and maintaining profitability on market data it has never seen before. A perfectly validated algorithm is still vulnerable to physical failure. If your home internet connection flickers off for 30 seconds during a major interest rate announcement, a critical stop loss might fail to execute. This network map illustrates the solution: a virtual private server, or VPS. Hosted in a data center right next to your broker servers, it runs 24/7, providing the ultra-low latency necessary to execute trades in milliseconds and avoid heavy slippage. You also need automated risk controls built into the system. A heartbeat monitor is a simple script that constantly pings your broker. If the connection drops for any reason, it instantly sends an alert to your phone. Alongside the heartbeat, your code should include hard circuit breakers. By programming a maximum daily drawdown, the algorithm will automatically halt all trading for 24 hours if your account equity drops by a specific percentage. Hosting your system on a dedicated VPS and encoding circuit breakers helps insulate your capital from the technical failures common in home setups. It ensures your logic executes exactly as it was written, regardless of whether your local internet connection is stable. Once your algorithms are live and secured, you have to face an uncomfortable reality. No code works indefinitely. Every single strategy eventually experiences strategy decay. This split-screen chart highlights the cause. market regime shifts. An algorithm calibrated perfectly for the low volatility horizontal channel on the left will be entirely shredded by the steep, high volatility breakout on the right. The code didn't break. The market environment changed. This is where your role evolves. Instead of executing individual trades, you act as a portfolio manager. You maintain a suite of different algorithms and use your human intuition to monitor the macroeconomic environment and decide which specific bots to deploy. Sustained success comes from recognizing these regime shifts early. It is about understanding the exact conditions your algorithm requires to function and taking it offline for recalibration the moment those conditions vanish. The Quant-Lite Framework delegates the strict discipline of market execution to the machine. This frees you to step back, observe the broader currency flows, and act as the system architect. To begin translating your manual rules into actionable code, download our systematic logic worksheet using the link below. And when you are ready to deploy your algorithms with true stability, explore FXNX VPS solutions and open an NX1 account to trade with 0.0 pip spreads and institutional-grade technology.